Hello and welcome to this week's instalment of Nucleus Investment Insights. This week our focus looks to the future of Australian house prices post the coronavirus pandemic. Whilst the world was gripped with the drama unfurling throughout the recent US presidential election, it could be said that the real noise, the whirring coming from money printers located at central banks around the globe, was somewhat drowned out in the hubbub. In an attempt to insulate the developed world's biggest economies from the forces of the free market, and to ensure that whatever dangers are lurking in the real economy, monetary expansion now appears to be the de rigueur to help minimise the impact of pretty much anything on the prices of stocks, bonds, and of course, real estate. The Reserve Bank of Australia joined the chorus of printing with a number of measures, including a key interest rate cut to an unprecedented 0.1% in conjunction with a $100 billion government bond buying program over the next 6 months, as it strengthens its resolve to rescue the Australian economy from its first recession in almost 30 years. So what does this mean for Australian property prices going forward? To help answer this question, we are lucky to be joined by a friend of the show, Martin North, who is founder of boutique research firm Digital Finance Analytics. Digital Finance Analytics combines primary consumer research, industry modelling, economic analysis and segmentation analytics to provide insight into the dynamics of the Australian property market. And Martin is host of the wildly popular Walk the World channel, available on YouTube. Martin North, welcome back to Nucleus Investment Insights.
Hi guys, good to be back and a timely conversation, I think.
It is indeed. More on that later. And also here to dive into the detail of the future of Australian property and how these themes can be used in our portfolios, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Jim.
Fantastic. And just a quick reminder that before we get started, to subscribe on YouTube and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. And right now, feel free to click like on the video to help our show grow. And of course, for those listening in live now, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. So let's jump into the agenda for today. So we're going to kick off with a question, I guess. RBA dropping interest rates to unprecedented levels. Will it work? We'll then roll into COVID impacts and household confidence. We'll then be looking at listings and values with some data from Martin. Mortgage stress as well. We'll then roll in and finish off any final viewer questions and then wrap it up as we do every show in our investment outlook and how we use these themes here at Nucleus Wealth. So to get us started, we'll kick off with the RBA decision to lower interest rates. Perhaps over to you, Martin, to get the ball started on your thoughts with the recent announcement from Phil Lowe.
Yes, well, thanks for that. And the title is good. What will it work? What's the it? And what are they trying to achieve, right? So what Phil Lowe said in his conversation just over a week ago was lower the exchange rate, support asset prices, and then he went on to say, and of course, we'll go on throwing more liquidity, in other words, more QE if we need to achieve that objective, and obviously long-term full or fuller employment, and therefore higher inflation. So that's what he's targeting. Now, of course, in the middle of that is house prices and credit. And so the fundamental question to me is, are those levers that they're pulling going to translate into more credit or even higher house prices? That's really, I think, the key question for today.
Absolutely. Over to you, Damien, for your thoughts.
Well, yeah, and I guess probably the first observation is they said, they want to try and get the, as Martin said, they want to try and get the currency down, and promptly the currency rose by sort of, I think we're up about 3 cents higher, so whatever it is, almost 5% higher than where they said they're going to spend all this money to get it down. But I guess it's, to me, that's sort of showing that all the other central banks are playing the same game, and they've been playing it for a while now. So it's good to see that we've actually the Australian central bank has arrived to where everyone else arrived at a few years ago, but they've still got a lot of work to do. It's not just a matter of sort of saying yes, we'd like the currency lower, and promptly the currency goes the other direction. Is they do need to get in there and start putting these policies into action. And I guess the other thing,
Damien, sorry, the point there is everyone's doing it, right? So if you're looking for differential moves between one currency and another, if everybody's doing the same thing, all trying to chase their currencies lower, it's going to be a zero-sum game.
Yeah, exactly. Got to do more. And then the other part is the bond rates. So all this money to get out there and hit the long-term bonds, and long-term bond rates have risen in the same time as well. So and quite substantially. Now not it's a lot of that. This is US and international expectations and things about vaccines and things like that. But it's really showing is that the things, everything that they came out and said they're going to be doing, they don't actually have a lot of control over, and they actually really do need to get out there and they can't just jawbone it lower. So the short-term rates they can. They've got they've already got their foot on the windpipe of short-term rates, and if they say short-term rates are going to 10 basis points, then that's where they go. And if they say that they're going to target even up to the 3-year, then it's pretty easy to get those down. But the longer they go out on the curve, and the more they target things that are like the currency that's sort of freely floated, they've just got to do a hell of a lot more than what they're doing at the moment.
And they did say, of course, that they weren't out of ammo. They could do more of the same if they needed to, and they could even go into the exchange markets if they needed to. I rather felt that was a bit of an air of desperation towards the end of the conversation.
Yeah. Well, but I mean, arguably the markets went, well, okay, you need to prove it to us.
Exactly.
And so, yeah, it will be interesting to sort of track that. But as you said, it's the question is what is it? And if the answer is full employment and higher inflation, and inflation between 2% and 3%, then it doesn't look like they're doing enough, does it?
Well, and their forecasting, of course, has been shocking for the last decade, right? So they're consistently undershot. And I know they've changed the definition now. So rather than trying to sort of shoot ahead, they're trying to sort of use a different method. But and that's following the Fed, by the way. But even so, the question is it likely that we're going to actually achieve what they want to achieve?
Absolutely. One thing that I've often had a bit of a giggle at, and it's when it comes out, is their wage growth predictions, which I guess plays into the inflation side of what they do as well. And it's just this falling chart. We've had it on previous shows, and it's just this banana going up. Okay, this year it's going to go up. No, okay, next year, and then next year, and it just keeps going down. It's like these little J's that keep sputting in. Anyway,
if you're running a reversion to mean model, I guess that's the thing, is you keep on, your assumption is everything will revert to mean if I don't touch anything. And so then that's what you forecast, and then it doesn't, and then you sort of have to come back and think about it. But I guess at least they're doing some more soul searching. I think in the past we've been and I don't want to treat this as being too great of a positive, but I guess in the past we've been frustrated by the fact that they basically say, well, we've been trying things for the last 3 years and nothing's worked, but next year it's going to work. And then they've been saying, we've been trying for the last 4 years and it hasn't worked, but next year it is. Whereas now at least they're sort of going, well, maybe we do need to change a few things. And so, I don't think they're quite there yet, but at least a little bit of self-introspection is a good thing.
Well, definition of insanity is doing the same thing again and again, expecting a different outcome, right? So at least they are doing a few different things now. The question is, 1, well, they were late to the party. 2, is it enough? And 3, to what extent will it be caught on the international cross currents, both geopolitical and economic? And those are, of course, the things they can't control.
Absolutely.
Yes. And then, so I guess your next step is saying, is when we're talking about this it again, what is it that we want? And if the answer is this higher inflation and is in the question, higher inflation and full employment, then there's this question about saying, well, with stacks of unemployment and way more underemployment at the moment, you're unlikely to get any wage rises come through. And so will rising house prices mean that inflation gets higher? And you say, well, yes, in the sense that rising house prices do make up a small part of the inflation index, but rents are falling.
It's via the rate, the rental proxy, right?
Yeah, and rents are falling.
Rents are falling. So in fact, you could be in a situation where home prices rise, but the rentals continue to fall, and the CPI goes backwards.
Yes, and then the question is, even if you could get the CPI up because you managed to get rental growth, is if people aren't getting wage growth, then it's a you're not going to get that. That's not going to go through the rest of the economy, I guess is where I'm getting to. Is it's a you tend to get inflation starts going when you can start getting wage growth, and then the wage growth starts feeding into every other input, and then those inputs all rise. But if if the only thing we've got going up is asset prices because of lower interest rates, then it's very hard to get inflation to.
Well, let's be clear. They're using the credit lever to try and support house prices and to get more people to buy more property to support the broader economy. But if you look at it carefully, there isn't a lot of evidence that all of that liquidity flow going into the system is necessarily translating into any real outcomes in the real economy.
No, but I think we go into some of those the credit stuff a bit later, didn't we?
We do.
Don't we? With the slides. Okay.
Speaking of which, we'll jump into the slides. And just for those listening in audibly, there's of course the link to the show notes and the slides in there in the show notes. Sorry, there's a link to the slides, so feel free to check that one out. Flogging a dead horse, big increase in broad money, not a lot of increase in credit. Martin.
Well, that's what I was trying to get at, right? So the fascinating thing around the world is all of this quantitative easing, all of this money printing, all of this liquidity injection into the banking system isn't necessarily translating into credit growth. And in fact, in Australia, total credit is on an aggregate level over the last year down at 2%, which is as low as it's been forever. So despite all this money sloshing around the system, and of course that includes JobKeeper, JobSeeker, the superannuation withdrawals, all the other stuff that's been thrown out there, all the liquidity. And the point is, you can create liquidity and you can throw it into the banks, but if the banks are unable or unwilling to lend, or if consumers or businesses are unwilling or unable to borrow, it's not going to work.
And there's also this thing that I've got about sort of what I call sort of real credit, which is not sort of, I suppose it's probably confusing when I say that because it's because of inflation. But I guess what I'm saying is when if you're a homeowner who can't afford to pay their mortgage, and so you're on a mortgage holiday, but you're still you're still increasing your debt, then you're adding to credit growth. If I'm not incorrect, Martin.
Correct.
Because you've got a bigger debt than the last time, but you haven't actually done anything to. Yeah.
It's just pushing it out, so it's accruing. And of course, refinancing. Quite often, when people refinance, they draw down more on existing borrowings, right?
Yes. Yeah.
And that's
exactly.
Another factor.
And businesses that need to borrow to meet cash flow concerns, is not a, it's one thing to say, yes, I'm borrowing because I'm expanding and building a new factory, I'm going to hire all these people, and so that's a good thing, or even just building a new house or whatever. But if you're saying, no, I'm borrowing or I'm drawing down a mortgage because I've lost my job and I need some money to survive, or I'm drawing down on my credit lines because I've run out of money and I can't pay my employees otherwise, then that's not a good, that's bad credit. Yeah,
and of course, the other factor is savings ratio has gone very, very high, right? And that's, again, thanks to JobKeeper, JobSeeker, the superannuation pull down, which probably was the biggest chunk of all, and also the principal interest holidays. And we'll show you later, my hypothesis, which I've developed, is that, in fact, a lot of the people who reach for those liquidity levers, for their own personal finances, weren't actually in financial difficulty.
Yep. Well, and that's one, actually, that's probably a bit of a theme of, I'll keep coming back to on this, Martin, is this whole inequality thing, isn't it? Is that when you fire a bunch of money at the economy, and it's look, these things are always blunt instruments, but it usually ends up in the hands of people who do need it, but often it also ends up in the hands of people who don't need it. And so if somebody's lost their jobs and now you've given them half their income back so they can still keep alive and everything like that, but you've also picked up a bunch of other people who were fine, and now they've got this extra saving that they can't actually spend because they've been in lockdown or travel restrictions and things like that, then they end up then going and either putting that back into the housing market or investing in the stock market or whatever it is in terms of that money.
So for CBA, for example, in the SME sector, was pretty generous in their ability to be able to allow SMEs to just hold off from making repayments, right? So that's one of the reasons why I had some of the highest holidays out there. And of course, not surprisingly, all of them have now come back on.
Yep. All right, so that was a nice little cover off on monetary. Maybe we'll jump across to fiscal. with the $1 trillion debt budget. I think Damien or Martin, sorry, yeah, if you like, you go. But no, I know Damien's put some stuff out on his thoughts on what should have been done in the budget. But yeah, fire away, Martin, if you like.
Well, I think we both agree that the budget is big in terms of the number, right? Huge debt. The question is the debt actually going to support the things that really will create long-term growth in Australia? And my own observation would be that no, it's not. It actually has essentially flowed into areas that probably aren't optimal, and particularly, for example, encouraging businesses to try and invest. If businesses have low levels of confidence and are unable to get credit, their ability to invest and get the tax breaks as a result of it are very low. So I think this budget was a complete disaster, frankly.
Yep, I'm completely with you there. I think it's I think the fiscal cannon was certainly big enough. They loaded it with more than enough ammunition, but then they just fired it in completely the wrong direction. So sort of it's a so I guess I've got a few different takes on it. The first one I've got is the supply side versus demand side, is saying we don't have a supply problem. It's not a problem that we're out there. People we've got this inflation problem because there's too much demand and people can't make stuff quick enough, and so prices are being bid up. The opposite problem is there, that we haven't got enough demand. People have lost their jobs. You need to support that, and so this budget is just got all this focus on companies, giving them benefits to tax cuts and all these things like that to go out and expand. And companies are sort of turning around and going, well, just a minute, I'm running at 60% capacity.
Yeah.
Why do I need to expand?
I don't need another factory.
Yeah. And then the next stage is you're going, well, the most obvious place for, if you're a business with capital expenditure that you need to do, the most obvious place to do it is to put in robots to automate your process and fire some of your workers. And so that's not what the budget's meant to be. That's going to make demand even worse if you just start doing that. So, and then we don't make any of these robots or any of the, most of that stuff all comes from, any manufacturing stuff comes from overseas. So we're basically saying we're going to give tax cuts to people who spend money on things that we're going to buy from overseas. And so effectively you're benefiting, the Japanese government, you're benefiting the German government, the Japanese consumers, the German consumers, or the Chinese consumers, because that's what we're doing is we're buying their stuff and giving a tax cut to people. Whereas I sort of feel as if you're going to give tax breaks and all those types of things, you want those tax breaks to sort of stay in the Australian economy and multiply around there. So if I give $1,000 to somebody, and then in the Australian economy, and then they go and spend it with somebody else, and then that they go and spend $800 with somebody else, and then that person goes and spends $600 with somebody else, and that so the original $1,000 multiplies into many multiples of what you originally spent. But if that person takes that $1,000 and promptly pushes it offshore, then it's multiplying in another country. It's not multiplying over here.
That's right. Yep.
And then the final one is saying, well, we've got this problem. The other demand problem is when people who are rich have more money, that they tend to save it, whereas people who are poor tend to spend it. And so if you basically take money away from poor people and give it to rich people, then you're effectively you're getting rid of demand from the economy. And so what we've done is we've given a big tax cut to rich people, and we've told the poorest of the people on job keepers and job seekers that we're going to take their money away from them.
Round up. Yep.
So so on all fronts, it's sort of like basically saying if you're trying to if we had a supply problem, this is a great budget for a supply problem, but we don't. We've got a demand problem, and so pointed in completely the wrong direction.
And just one other point there, Damien, the net migration statistics, right, was pretty shocking, right? So we've been relying also, the other growth lever was more people, right? And now they're suggesting we're not going to get more people for the next 2 or 3 years.
Yeah, and that's just right. So I guess we've got this structural change happening, and whether you say, like, the initial thought was, hey, this coronavirus thing is going to be around for a couple of months. Let's just let's put all these processes in place, and then just so all our companies don't go bust, and then everything will come roaring back, and we'll put people back into working in airlines and tourism and education and all these other factors. Now that we know that's not happening, what you want to do is try and support people and say, well, if we're going to go through a structural change, we need to support people who were flight attendants to become, manufacturing workers, or in the service economy in Australia, or whatever it is. Things if you're saying this isn't coming back for a few years, we don't want to have all these people hanging around without jobs for a number of years until tourism finally comes back, or until the education finally comes back. But again, we've done the opposite. We've said, no, let's just try and keep everything as it is, and rather than actually get in and support people to change jobs, there's been very, very little within their budget to do that.
Yep.
I agree. And the opportunity, I think, was there to create some sort of, I suppose you'd call it a Green New Deal, but, positioning the economy for a different future, a different shaped future. What they've done is gone back to the future, unfortunately.
Yes.
Well put. All right, very good. So we've had monetary, fiscal, and then we might have a quick look at household financial confidence as well. Martin?
Yeah, and that's really interesting because, of course, the Melbourne Westpac stuff came out, and this was sentiment, right? And they said, oh, it's the highest in 5 years. Now, I think that's more to do with the fact that people are highly relieved with regard to the virus being under control and those sorts of things. There seems to me to be a different lens if you specifically look into some of the financial confidence data, and the ANZ Roy Morgan one from just over a week ago showed there was a slight recovery, but not a great significant recovery. And that's consistent with my own analysis because I also produce a confidence index. So it's up a bit, but it's still way below the long-term average. And in terms of my confidence data, I can point to a few different things. One is we've got 3 million savers who are now basically getting nothing from their savings, and that's creating huge issues for many of them. We've got around 20% of SMEs who are still not sure they're going to be around in 6 to 12 months' time, so they're not investing for the future. And we've got a lot of people whose jobs are at risk or unemployment is there, or, as you mentioned earlier on, it's part-time work, less hours. The Roy Morgan number there is 20%, 1/5 of households with no jobs or less work than they want.
Yep.
Now, those are the raw numbers. So in the context of, there's some better news than where we were, so you'd expect some improvement. But I think if you look at the real hard economic data and you look at the confidence issues amongst households, it is nowhere near as strong as perhaps the Melbourne Westpac data suggests.
Right. Yep. Anything on household confidence, Damien?
No. Well, actually, it's probably worth saying with a few of these indexes out there, and the household confidence isn't one that does it. But there are a lot of things like the purchasing managers indexes and a few things like that are all based on how do things look versus last month or the prior month. They're not about absolute position. So I sort of concur with Martin that I think things are much lower. They're definitely improving, but you just need to make sure as you're looking at some of these indexes, what it's trying to show, and some of the things you see overseas in particular, but they call them PMIs or PSIs in terms of services indexes or manufacturing indexes. But keeping in mind that they're showing, yes, things are getting better, but it's from a really bad place. And so, getting back to that original point is what's important.
And it's the same argument as GDP, right? If GDP drops 10% and then comes up 1%, right, that will still be a positive percentage change, but it's actually off a very low base. And so sometimes you can see a positive percentage change with it actually not being very relevant in terms of, what's really going on.
Yeah, well, and it's because we've had such a massive drop in things, the percentages start playing havoc with you as well. When you fall 50% and then rise 50%, you're actually 25% lower than where you started because you fall from 100 down to 50 and then 50 back up to 75, and so you're still well below where you were. But it sounds as if fell 50%, rose 50%, I'm back to the start, but you're not. You're a long way from it.
Yep, fair point. Okay, very good. We've got a chart of yours up here on household finance confidence as well. I'm not sure if we just covered off on that in the previous bit, but yeah.
Well, just to make the point that it has improved, but it's still well below the long-term average. And what we're doing here is looking at all households across Australia in our survey. So that's 52,000 in the sample. And basically, we take a whole bunch of different dimensions from savings and costs and all those things. And the other interesting observations, cost of livings are still rising. So people are now having to pay more for childcare than they were previously. The costs of many goods at the supermarkets are higher, and that's a consequence of all sorts of things. In terms of savings, that's terrible because the rates are so low, although those with stocks and shares are actually doing very well. And that's back to Damien's point, the more affluent people are actually way more confident than those who are less affluent. And the other point to make is that if you look at it from a property perspective, owner-occupiers are a little more confident because the rates have come down. Property investors, their confidence levels have never been lower. So if you're in the property investment sector, they're really, really concerned now about falling rents and the fact that there's very little capital growth in property at the moment. So, as you get into granular, you start to see some of these rather important landscape issues. And frankly, asking them then, are you likely to spend more or less in the next 12 months? Well, the answer is yeah, I might spend a bit more, but I haven't spent very much in the last few months. So therefore, it's all these relativities come through.
In the one I'm interested, Martin, I don't know if you've got it handy, it's probably a bit of a surprise one, is what you're saying there about the investors at record lows.
Yep.
Has that got a bifurcation in terms of basically going, well, if you're an investor who's got a house and the person in it's still paying their rent, and you've just had your interest rates come down, then you might be quite happy, and you're not doing your annual trips overseas, and so you're actually accruing a bit of money and thinking, well, maybe I will go buy another house. Whereas there's a lot of people who have seen rents fall, or anyone who's been without tenants, or tenants haven't been able to afford, then they're going to be sort of dragging the average down. Does that make sense?
Yeah, so I can split it into three groups. The portfolio investors versus the solo investors. Portfolio investors are still generally a little more confident. It's the mum and dad property investor with perhaps one or two properties. Suddenly they find that they've got a vacant property, or they've got somebody not paying rent.
Yep. Or discounts.
They often are younger when they, so I've seen a lot of young affluent people buying an investment property. They bought at the wrong time. They bought in 2017 when prices were at their absolute peak. Prices are now lower, so they got a capital loss. They're seeing the occupancy drop. They're seeing the returns drop. And of course, the other factor, with interest rates dropping, they get less benefit from tax breaks.
That's right. Negative gearing benefit decreases.
Correct.
Yeah, sure.
And then the third one is
any tears over that for anyone. You're making more money, but yeah, I know what it is. I know what you're saying. People overestimate how much they get back in the tax benefits. Yeah, I've only lost $50 this year rather than losing $100, which means I get a smaller tax gain back. It's like, you only lost $50. Don't be upset. Yeah,
it's all relative. The other point there is big differences in Queensland relative to Victoria.
Yep.
Right. So yields, net and gross yields in Victoria are way down relative to Queensland. So one of the reasons why we're seeing quite a lot of drift, and there's a slide later I think we might touch on, drift from Victoria into Queensland, is that the rental returns are 3 times, net rental returns on investment property are 3 times what they are. So that is very important to understand too. So you have to go granular, you have to look at geographic. The final overlay is units versus houses. So property investors with a portfolio of units are the worst performing in terms of confidence.
Yeah, which makes sense in terms of the number of units out there has certainly increased, and people wanting backyards. So in case they go back into lockdown, and
absolutely, yeah, it's been a saving grace for us. We'll jump across to the next one.
Sorry, just before we go from that one. WA. So you said Queensland's doing quite well. What about WA?
WA looks as though it's turned a corner in terms of rental returns. In fact, rents have moved a little up in WA, and the supply, which was very, very loose, is now tightening, but it's not uniform across the whole of Greater Perth. If you go down to, and I keep picking on Mandurah, and I don't mean to, but Mandurah is one of those outlying suburbs down the coast where they've got still massive supply, very low rental returns, very high levels of negative equity. There's very little improvement there, but closer into Perth, it's definitely better. And again, different dynamics, houses and units. So my read is that WA is probably actually the better performing state at the moment across Australia.
And having, I guess why I'm sort of picking them as my sort of, the one I look at the most is they seem to have been the least affected by the virus. I guess that's what I'm thinking, is that, they're is this a vision for the future? Of if things are, if you can manage to stabilize things in a little bit of a bubble in Australia, the North America might be going under, but there's no real travel, and
Well, the point of WA, of course, is they're massively supported by the exports to China. which
Yes.
are of course still there, sort of, although there are a few question marks around some of them now. The obviously the tourism sector, international tourism in particular, is completely dead as it is in other states.
Yep.
So I wouldn't overplay the differences. What I do think though is that the early shut of the borders and the real control of the virus early shows you how important it is to do that, because the economy over there, and if you talk to people in WA, they're pretty much behaving like normal at the moment.
Yep.
Whereas in other places, of course, it's very different. So.
Yeah, I speak to a lot of people in WA, and it's all through the last few months, it's been quite difficult to speak to them. But anyway, they're having a good time over there. So yeah, they're very good. Well, we're on the state topic. We've got the unemployment impact of the coronavirus on unemployment by state.
This was a Roy
here.
Morgan piece of analysis, and I just thought it was fascinating because basically their conclusion was that 70% of working Australians had their employment impacted by COVID-19. 70%, that's a big number, right?
Huge.
And that includes being stood down, reduced hours, working from home. And there were another 1.6 million, or 10%, cited other changes such as enforced leave, changes in work rostering, social distancing at work. So as well as the direct financial consequences, people are actually also feeling it through other mechanisms. And basically, the takeaway from here is that a greater proportion of people had significant impacts from COVID-19. And that's really my point, because it'll come to my thesis as to where prices are going to go. It all comes back to whether COVID-19 can be controlled or not. Because frankly, if it can't be controlled, then the consequences are very dire. If it can be controlled and quickly, then the path to recovery and better economic performance and outcomes is more certain.
Yep. Anything from you, Damien, on that?
No. We better stop jumping in because we've got a few important slides to go.
We've got a couple to go, so we'll press on. Now, we have touched on obviously the falling or zero, net international immigration. We've got a good chart up here, I think, just covering off on that. Is internal arrivals and departures from Melbourne?
This is the interstate movements, right? Yep. So, in summary, there's about 4,000 to 5,000 people net moving between Victoria and Queensland. So that's a net drift. And also a net negative drift from New South Wales to Queensland in particular, right? That's a very interesting phenomenon. And if you translate that into houses and apartments across Australia and who's selling and who's buying, what that means is there's probably about 50,000 too few standalone houses required across the country, particularly up in places like Queensland. And there's around 600,000 too many units, if you include those who are trying to sell, across Australia. So this tells you that there's some huge differences, again, by state and also by types of property.
And the other thing to note is, all the China's obviously upping their game in terms of cutting down their exports from Australia into China. And one of the other big exports is obviously, or the two big exports is tourism and students, both of which are effectively shut down now anyway. But it's a pretty good sign, though, that both of those, the Chinese leg of those, even if we opened up tomorrow, wouldn't be coming back very quickly at all. I think they will be, given how they're not buying our copper and coal and all these other things, is it seems unlikely they would then want to open the borders and send as many Chinese people as possible to Australia. I think there will be a lot of incentive for Chinese people to holiday elsewhere.
I think both students, so the education sector, and tourism has been permanently damaged, permanently changed. I think it's highly unlikely that we're going to see anything like the numbers ahead.
Yep. Speaking of numbers ahead, we've got dwelling prices now rising 0.4% in October. Thoughts?
Yeah, so this is the CoreLogic series, of course, which is the one that came out very recently, and they're basically trumpeting the tremendous rise in property prices. Well, slight rise in property prices, 0.4% over the month nationally. Just remember that this is a hedonic index, so it includes a lot of stuff within the black box to try and get to these results. It probably doesn't necessarily reflect everything that's going on. My own view is that these numbers are probably a little more positive than they really are in practice. But again, you have to go granular, because there are some places and some locations and some types of property that definitely are rising, but there are still others that are not rising. And so we need to be a little bit cautious about this this so-called miracle turnaround in property prices.
Sure. Any thoughts on property prices, Damien? Or
Let's get going.
yeah,
We've got the
leave it to the mate. Turning from prices to listings. So big number of
this is
listings.
interesting.
Yeah.
This is from SQM, right? So basically, there's a significant rise in listings. Obviously, big rises in Melbourne, but also in Sydney. And what I'm seeing in my surveys is a lot of people have been sitting on the fence thinking, do I put my property in the market? And particularly those who I call down traders. So these are people sitting on equity. They've sat on equity for a number of years, perhaps bought 5, 10, 15 years ago, and they're wondering whether they should sell. Plus, we've got property investors who are also, as we discussed earlier, now finding it quite difficult to figure out how to make a return. So I think we're going to see more supply this side of Christmas, but even more supply after Christmas. The other factor there is that with the repayment holidays now coming to an end, the banks are putting a bit of pressure on some households who've got permanent damage to their incomes now to put their property on the market. They don't want to foreclose, and they're giving them more wriggle room to another 4 months of interest holidays, but they're also suggesting that perhaps they should consider putting their property in the market. And I've spoken to a few estate agents in the last couple of weeks, all of whom confirmed that they're getting more people now knocking on the door saying, we are considering listing. So I think we're going to see higher listings ahead. And of course, higher listings suggest that prices will perhaps slide rather than rise.
Yep, it's a fair point.
Yeah, and I think that's obviously the banks are out. I think they're trying to contact everyone, aren't they, Martin? Who's
they were obliged to.
Yeah, and so that's I guess that's the thought is that they don't actually have to report these people as bad debts or anything or at the moment, and so
Yet.
Well, in fact, if they restructure in some way, then APRA says you can reset the clock.
Yeah.
So it's now, and also we know that quite a few people are avoiding speaking to the bank. Right? Getting lots of who we're not here sort of thing.
Yeah, it's fascinating.
But yeah, so it is that. It's certainly interesting, and there's another. We've still got a bit of a wave of buildings being finished though as well, don't we? All the apartments that.
There's about 150,000 apartments in construction at the moment, under construction. Building approvals, of course, are down, and again, people have been citing this very volatile high-rise unit approvals as up and down, but it's still relatively down to previous. But also, we know that a number of construction companies are slowing the completion of properties, so particularly high-rises. So they're not trying to run them quickly,
right.
And in some cases, they're doing things like trying to rent them directly, so rather than trying to sell, or they are doing other things, for example, offering a cash back. So in other words, you settle at $900,000, say, but you get $100,000 back afterwards. So the true purchase price is $800,000, but it's reported in the official transaction at $900,000. We're seeing some of that now as well.
Right.
Fascinating.
Yes. Yeah, and then that stuff in corporate. Commercial stuff's always been there though, and it's always. I find it fascinating whenever you look at those ones, and it's probably more on the rent side, but it's basically saying, well, will you pay us $20,000 a month for the rent? And people are like, well, no, I'll pay you, whatever, I'll pay you 15, and they're like, okay, how about we call it 20, and I'll give you, $100,000 worth of, I'll give you a couple of months for free, or I'll give you all this extra, I'll do all this work for you at this sort of inflated prices, but I'll do all this extra work to fit the place out, but you still say that you're paying 20,000 so that I can get. I can tell the bank.
The other one with the residentials, they throw in a car. If you've seen that one, so rather than discounting the price in the estate by 30,000, they'll just go and bulk buy some cars, and they'll add it. They'll throw a car in your new garage for you if you pay the sticker price, which is quite a good one as well.
They'll pay stamp duty. Seen that before.
Yep.
Or they'll even guarantee if you're going to use it as a rent, they'll guarantee rent on the property for the first N years, right? Or even pay your mortgage for the first N months.
Yep.
Yeah.
Area of desperation.
I have a distinct memory of I was sort of, I don't want to call it moonlighting, but I used to work for Aegis Equities Research, and we had some unlisted property stuff, and the property guy was really sick and needed somebody a replacement. I remember just walking around. This was sort of back in the 2000s or whatever, late 2000s in the Gold Coast, and he was talking about all these rental guarantees, all these places that had been rental guarantees. And we're saying, oh yeah, the ones here they're coming to 3 years, and X% of them have never had a tenant.
Wow.
But the owner doesn't know because
Just gets paid.
yeah, because it gets paid, and so
Wow.
and so they're about to find out that they've never had a tenant, but they didn't want to lower the rents. They could get tenants if they lowered the rents by $100 a week, but because they'd told all their investors, no, you're going to get a 5% rental yield, is that, and we've guaranteed that for you, is they needed to keep the rents high, and they prefer to actually keep them empty so they can get more investors in until finally they went, okay, now we no longer have to. Here's your
Bombs away.
Welcome to your apartment. Yeah, you've never had a tenant. You've got a brand spanking new apartment still, but guess what? You're going to be getting 75% of the rent you thought you were going to get.
And a big capital loss when it all gets repriced. Mortgage stress, Martin. So we've got your first chart up, and we've got a bit of a focus over the next few slides on mortgage stress. Maybe just before we jump into where it's at, if you wouldn't mind, just for the listeners, just providing a bit of background on how you get to this level of all this information and what's sort of sitting behind the data.
Yeah, so this is based on, again, on our surveys. It's a rolling 52,000 household sample with new coming in every week, in fact. So it's very up to date. And what we do is we look at household balance sheets, money coming in, money going out. Do they have enough money coming in to meet all their obligations, including paying their mortgage or indeed paying a rent if they're in a rental environment? So it's a cash flow based view. They may have assets, they may have savings, but nevertheless, I think the cash flow view is the most powerful. Now, there are other measures of it. Some people use a set percentage. One of the other major research firms reports mortgage stress on a completely different basis. They use a fixed percentage. And in fact, AMP came out today with some research suggesting that 1.8 million households were severely in financial pressure at the moment. So lots of different ways of doing it, but we've done this consistently since 2002. So we've got this long-term trend in terms of cash flow. And what's interesting, if you look at the shape of the yellow line, you can see that it was tracking relatively similarly up over the early 2000s. It then dropped post the global financial crisis. It then continued on its merry way up to about 32% in February, and then it's really accelerated away because of the virus and the lockdown and the economic consequences of that. And it's now at 40.6%, which is as high as it's ever been. So that means that 40% of households with a mortgage are under financial pressure. Now, that doesn't mean they can't pay the mortgage, but what it does mean is if they do pay the mortgage, they're going to have to give up on something else, cut back on spending, put more on credit cards, do other things, right? And there is a consequences because this is an early leading indicator of potential problems ahead. Remember, unemployment's going to rise from this point, not fall. Remember that wage growth is not going to be there, as we discussed earlier. Cost of living are continuing to rise. So this shows you that there is a certain amount of insecurity amongst households. Because of this long-term trend and because of this spike that we've seen, we think this is a very significant issue. And it's also worth noting, by the way, that the debt to income ratio is also it's very high as well, and we know that from all of the other data, including the RBA data. So we've got very high household debt, large mortgages, and we've got 40.6% of households with a mortgage in difficulty.
Yeah, and it's just that steady climb, isn't it, over the decades, and then now it's sort of turbocharged. It's starting to hockey stick.
Well, it's suddenly taken off.
Yeah,
really is. And that's a worry, right?
Yep.
Now, if you go to the next slide, you can actually look at that in more granular view. And this is, if you like, my killer summary slide by state, because it shows you the amount of mortgage stress, the amount of rental stress, even stressed investors, because we also measure stress. Now, when we look at stressed investors, we're looking at those who have a problem with cash flow because they haven't got rents or because they've got vacancies or they're trying to sell, those sorts of things. And you can see then the relative percentage. So in terms of mortgage stress, we've got the highest levels of stress in Tasmania, and then in Victoria, 50, then 43%. In terms of rental stress, it's highest in New South Wales at 49.5%. In terms of investor stress, it does vary. In fact, the ACT and New South Wales have the highest percentage of investors. And we then have an aggregate financial stress metric. And this includes now data from households, but also from the SMEs, because of course SMEs often have mortgages as well. And you can see that the highest degree of financial stress is the top level is actually in the ACT and the New South Wales at 45.4 and 45%. And what that tells you is that, we've got 1.5 million households with mortgages struggling with cash flow. We've got 1.7 million households in rental cash flow issues. And we've got around 800,000 stressed investors. Or put it all together, we've got more than 4 million households who are under financial pressures at the moment. And that's a significant dampener in terms of what may happen to property prices, but also what may happen to the broader economy.
And do you have the other side of this, Martin? Do you know is it, I don't know, maybe it's, so I guess what I'm asking there is the people who are sitting there going, wow, how come my savings account's so much higher? I haven't realized that not going out to the pub and not being able to take a $10,000 skiing holiday is going to be able to would add so much to it. Yeah.
Absolutely. So we also have another, I haven't got them here, but we have data that shows that there is a significant boost of wealth, and the profile of those with wealth improvement has tended to be more affluent, larger shares of investments, particularly stocks and shares. And so you're absolutely right. There is another whole cohort who are saying, crisis? What crisis? Everything's fine. And basically saying, well, I haven't been able to save, so I'm going to go out and save. Now, that's the bifurcation that I'm seeing in the economy, right? So we've got this really large group that are in difficulty, but we also have this other group who are thinking everything's fine. And there's light between them.
Yes, and I guess what and in the over the last 6 months as well, there's been all these government plans and policies to then say, okay, well, we're actually going to limit the number of bankruptcies. We're going to let people have mortgage holidays. We're going to do all these things that will actually that sort of help the bottom one or stop the bottom ones from turning worse, and sort of at least hold them in a stasis, or maybe even just they're probably still getting worse, most of them, but it's only incrementally worse. Whereas the top ones have actually been booming away. And so I guess what we're tossing around is, okay, well, if that's a reason for house prices holding up, and it's a reason for stock markets going quite well, this isn't just Australia, it's playing out sort of globally. It very much relies on that, basically you're saying we're suspending capitalism for the lowest part, by not letting people go broke and not letting them and letting them just accrue these mortgages. When do you stop? And it's very hard. It seems to be every time one of these deadlines comes up, it just gets rolled over. And so, I'm sure at some stage this starts blowing up, but I guess we're kicking around going, well, how much longer could they? If you just went, that's it, I'm never going to let anyone go broke again. How long is it before you actually create even bigger problems in your economy because incentives and people not paying bills, the bad actors not paying bills to the good actors drags down the good actors, and
Well, it's really significant in the SME sector, right? So we know that there are SMEs trading that are actually insolvent. And they are, of course, racking up bills with people who are actually other businesses who are not insolvent, and they don't know they've got a bad debt problem, but they will have later, right?
Yes.
And that's the problem. And it's a bit the same with this situation. We know we've got many households who are sitting on higher levels of savings, and they'll probably spend some of that, and that will help to support some parts of the economy. But we've also got this other group that are actually protected by the principal and interest repayment holidays, JobKeeper, JobSeeker. And by the way, JobSeeker numbers are going up, not down at the moment, according to some of my data. And the overall hours worked and the overall income has dropped. So we're not out of the woods. So it's going to be a push-pull. It's going to be, there's a proportion of the economy that's certainly firing better, but there's another proportion of the economy that's not firing that well at all. And it looks to me as though we have yet to see the consequences. And your point is dead right. We are no longer in a free market capitalist society, right? We are in a state-controlled, manipulated, fiddled with society. And the question is, can you go back? And what are the consequences of going back? My view is they'll just go on doing this until after their next election. But at some point, surely they'll have to come back to reality, surely.
Yeah. Well, and I guess it's this. I guess that's what we're kicking around now, is going, how long will, let's say the SME sector is saying, yes, okay, you can just say, yeah, sure, no worries, companies don't have to go broke anymore. But eventually, as you said, the good guys start getting dragged down as well, and some of those good ones will go broke. They'll just say, oh well, I can't afford to pay my bills, and so better they go broke now rather than leeching away forever. But you're going to create other problems in your economy. Like it's not a solution. is to ignore it. But you can ignore it for, I don't know. So we ignored it for 6 months now without too many effects. Can we ignore it for another 6 months? Probably. Can you ignore it for 2 years? I think you're starting to stretch it at that point. But
Well, it depends on how big a deficit you want to build.
yeah,
And remember, we're at 1 trillion, or is it 1.8? 1 point plus. Already. How much more will they rack up? And the answer is they seem quite happy to rack up a huge amount. So
well, you can rack up stacks. Yeah, and I guess it's that part though as well is debts. I'm the first person to argue when you can borrow for 10 years at 1% and your inflation target is 2 to 3%, then you should be out there spending money. But what you shouldn't be doing is out there on productive things. So if you can go out and build infrastructure that's actually needed rather than a bridge to nowhere, if you can go and reduce everyone's energy costs by investing in various energy things, all these things like that, where you can actually see a return on it, that's great. If you're saying I'm going to give some money to banks to prop up companies that should have gone broke but haven't gone broke, then you're throwing that money away. You may as well, yeah.
Right, and just remember, if you take a global view, that's what's precisely been happening in other centres as well. So the Fed is, through their liquidity programs, they're supporting large companies, they're supporting bonds, the bonds market, which means we've got lots of zombie companies around the world who are basically enjoying these ultra low rates. Essentially, you could argue that capitalism is dead.
Yeah. Well, it's certainly suspended at the moment, and hopefully it doesn't die while the patient's in a coma. Hopefully we can bring it out of the coma. I'd like to. I'm going to think of this one as half full for the moment, Martin, if that's all right with you.
Yeah, no, that's fine. Well, I'm of the view that the whole idea of capital is it goes to more productive uses, right? At the moment, unfortunately, capital is being sucked into things that should probably be allowed to fail, and that's ultimately the risk that I see we take. But it's political. This isn't economic. This is political. People don't want to let anything fail, so they're trying to keep all the balls in the air. My vision. I don't know whether you've seen these plate spinners, right? Who got these plates on sticks, and they've got lots and lots of plates, and they're trying to spin all these plates and keep them all in the air. That's what I feel like we're in at the moment. We're spinning all the plates. Everything's in the air, but how long will it stay like that?
Yep, absolutely. Feels like it's getting close. We might just quickly jump across to segments in interest of time. Just looking at the leftover slides as well. If you'd like to run through and we can talk about the people who deferred and not stressed, which I'm looking forward to as well. But first the segments.
So just quickly to highlight that you've got to look at granular again, different types of segments. So if you look at financial stress, it's quite broadly spaced. We've got exclusive professionals and young affluents. They're the more affluent end of the market. They're in financial stress. If you look at some of the what I call the battling urban and the disadvantaged fringe, the people on the outskirts of towns, they're in difficulty too. So this is just a chart to show you how granular you need to get to really understand what's going on. And interestingly, mortgage stress is probably higher among young growing families, a lot of first-time buyers there. Rental stress is more mature, stable people, and even stressed seniors. And investor stress, this is the most interesting one, investor stress is highest amongst the exclusive professionals. They're the ones with the portfolios of properties. They're the ones who've geared up big time to actually make investment properties work. And as we said earlier on, it's turning to soup. So this is quite just another way of thinking of the same problem.
Yeah, that's some scary stats there. The rural family one's quite interesting. Obviously, sitting at the pretty much polar opposite of all the problematic segments.
Correct.
Is that a common thing though? Is rurals generally sail through a lot of these sort of issues?
So, partly because of course they've had less exposure to COVID, so things are still running along. They've still got the drought broke, so they've got some more agricultural output coming there. And it's interesting that over time, despite the drought, rural families have tended to actually motor through.
Yep, interesting. Very good stuff. All right. Well, some who have deferred but are not stressed. We might just need to explain what that means.
Now this is a bit of analysis that basically Damon asked me to do. So the first thing to look at it is, and this is income bands along the bottom. So from 20 to 60 to that sort of thing along the bottom, right? So you can see the household distribution. This is gross income, right? Then what I've done is plotted the relative stress concentration. So in other words, relative to the proportion of people at that income band, are they over or under 100%? So you look to the right-hand side, and you can see there that there was a lot of stress in the low income bands.
Yep.
Right. Lower stress once you get up to sort of 140, 180, 220, 260, right? But then I also looked at those who actually got deferrals. And this is the principal and interest deferrals.
Yep, sure.
In particular. And what I discovered is that there are a lot of people in the 180 to 330 income band group who are actually less stressed, but had a greater representation of deferrals. And this goes back to my theory that, and I sort of focused in my surveys too, quite a few people took the opportunity just to not make any mortgage or principal repayments for a period of time and put some savings in the bank. And ditto, because I've got a similar analysis, but I haven't shown here, a similar analysis relating specifically to the superannuation withdrawals. A lot of people took the advantage, particularly those who were slightly more affluent, slightly more informed, grabbed the money and stashed it away. I think this is probably one of the most interesting observations of this current environment. So you would expect to see a significant reversion as people are actually reactivated and people are making repayments, right? You would expect that. But you've still got this hard core of people who are stressed. And I think that we're going to find that last 25% of people on deferrals will ultimately get restructured to interest only or will have to sell. And this is going to play out not over the next 3 months, because the thing runs on at least till March. It probably will be postponed again. CBA said that they would actually not start anything until September next year. Of course, that's given more leeway. But this is a big deal. So my hypothesis is that from my data, we've got this core now, this core group of people who are financially in great difficulty, will be unable to extract themselves without considerably different strategies, and they may well have to sell their properties. That, for me, is one of those very important leading indicators that tells me that there is going to be more supply of property and perhaps even less demand over the next 12 to 18 months.
Fantastic. Yeah, no, look, that's some great analysis, and I think you're right. Certainly the superannuation drawdown, even just anecdotally, I know a lot of people who probably didn't need it, but thought, this is, probably a rare chance to get access to super, so I might as well have a go. As I think, as you said, towards the start of the show there, just a huge amount of private money stimulus in the aggregate of the superannuation drawdown. It was just a phenomenal amount of money that was just directly fed into the pockets of consumers, but of course it was their own money.
It was the biggest chunk. It's about 35 billion net, I think. That's the biggest. The JobKeeper and JobSeeker were about 7 or 8 billion.
Yep.
Right, and the interest and principal deferrals were only about 3 billion in terms of the overall. So you can see where that money came from. You say it's their own money.
It's their own money. Some sort of stimulus there. Anyway, very good. We'll zip through. So we've got the Queensland geo map here.
Yeah, I just all I wanted to show on this. This is mapping financial stress. It's not uniform, so I won't go in detail because it's too complicated here. But the point is, you have to get granular. There are postcodes where SMEs and households are in great difficulty. There are others where it's less of an issue. And you have to go granular to understand where the most significant downward pressures are going to be on home prices and on businesses, and therefore where we expect JobKeeper and JobSeeker. And by the way, I've mapped JobKeeper and JobSeeker to these same maps, and they are absolutely aligned.
Wow.
So there's a significantly higher number of people getting support in the high financial stress areas.
Makes sense. And over to Victoria.
Yeah, same there. You can see there western and eastern side of Victoria, up in north as well. So there are again pockets. A lot of those pockets are in the high growth corridors, those newly established areas. Narrow Warren, places like that. It's just consistent patterns. So there's an alignment between financial stress, mortgage stress, JobKeeper, JobSeeker. So again, go granular. You have to go granular. You can't just pluck out a figure for the state or a figure for Australia. You have to get into detail to understand what's going on.
Sure.
And the other thing I think from those ones, my rough eye looks like the apartment-heavy suburbs as well, are probably the ones that are...
Funny that.
Yeah.
You're absolutely right. Apartments, if I was thinking of investing in property, I would not go near apartments at the moment. All of the indicators, both in terms of my price indicators as well as the stress indicators, would suggest to me that the apartment market in many areas are going to get massacred.
Yep. Tend to agree. Okay, non-performing loans will rise.
Yeah, so this is just from the latest RBA data set, and I just thought I'd highlight the fact that things are not looking hugely good with terms of non-performing loans. Remember, though, that non-performing loans are being masked at the moment. In fact, Genworth, in their recent reporting season, said, we don't know how bad the delinquencies are because it's untransparent as to what's going on. Well,
Wow.
surprise, surprise, there's no definition of a poor loan. There's effectively the principal interest resets going on. So the banks are able to extend and pretend at the moment. This is going to come home to roost at some point. So whilst on one hand you might actually see house prices rising in the short term, you've got this underlying question of loan performance and therefore property prices. I think this is something we've got to watch very closely over the next few months.
And keep in mind as well, this is a global phenomenon as well. Like there's, I think bankruptcies are down, depends on pick your country, but it's somewhere between 20 and 40% versus last year. And so this is I keep coming back and going, so is this we think that COVID's actually been great for bankruptcies? Like those people haven't, these people that would have gone bankrupt haven't gone bankrupt, or we've actually just delayed and we've got this huge pool of people sitting there that are going to go bankrupt. We're just waiting to try and leak them out. And so, even if you just went back to normal bankruptcy rates from current levels, you're going to rise by whatever it is, 50, 60% from current levels just to get back to normal levels. Yeah, and then you got to have all the people that were sitting there and should have got the catch up as well.
I was speaking to some insolvency practitioners the other day who said they're so quiet, but they know that it's building, right? It's like that storm in the late afternoon. You can feel it building. And the question is, at what point will they actually it all come through?
Yep. All right, we'll jump across to some of your summary outcomes. I always love these when you come on the show, Martin. So let's kick off with a series of scenarios.
Actually, no, I run different scenarios because it's too complicated to try and put one stake in the ground. Just to say that my best case scenario, which is the vaccination comes through quite quickly and we get the virus under control. Frankly, the virus control is the critical thing. There is still a path to house prices rising. Maybe 5%. The RBA's baseline, I would suggest, would be looking at house prices 10 to 15% over the next 2 to 3 years. So there is definitely a path to house price rises. But overall, I would give that 30% a best case, a 5% to the RBA. More likely, I think we're going to have a longer term crunch. I think it'll be longer to get the virus under control. I think the borders, particularly international borders, will stay shut for longer. I think the consequences of the SME things we've been talking about, the mortgage stress we've been talking about, the bringing forward of first-time buyers, there's a limit to how much that can be done. So I'm actually putting more weight on a small fall, not a massive fall, but maybe 10 to 30%. Well, I call that longer term crunch. There is a risk that we get another multi-wave virus outbreak, particularly if we open the international borders incorrectly. Look what happened in Victoria, and I give that a 20% weighting. There's also the small risk of an uncontrolled pandemic with, I noticed up in, is it Denmark, they've got minks with a new version of the virus. So, such as that is feasible. But look, my main case is a slight fall, not a massive fall, but a slight fall in prices, units more so than houses over the next 2 to 3 years. I find it very difficult to put any argument up as to why we would see a very, very strong rise in prices as we saw in up to 2017. So prices more likely to be sideways, in a best case slightly up, but more likely slightly down, with all of the stuff that the banks have been doing and with all the stuff that the Reserve Bank has been doing.
Very good.
The other one I think is worth noting in this as well is I reckon you got to add it into your add a column in for this one, Martin, is the term funding facility, what the rate on that's going to be. We've been banging on that for a little while, but to me that's now I don't care what the RBA rate does, because that's the term funding facility is so much cheaper for banks to fund their 3-year mortgages, which is why when you look at if you're a consumer out there looking at mortgages, you can pick up a 3-year mortgage much cheaper than you can pick up an overnight mortgage or a variable one. And and that's because the RBA is funding them extra cheap to banks. And what's happened overseas is they started, in Europe, is they started down the same path, but now they're actually paying banks 1% to lend the money. So in Germany or France, you can basically borrow at 0.5%, and the bank that's lending it to you gets paid. So you pay them 0.5% in your mortgage, and then the central bank turns around and gives them another 1%. So that basically doubles your interest payment in order to incentivize the banks to actually do it. And so I'm quite. I think that's coming here. It's only a matter of time.
And the other point to make there is they're, of course, using less international bonds now. So if you look at the mix of funding, because of that TFF, so effectively the bank's overall funding costs are going down. In other words, all the initiatives that are in the budget are actually bank keeper, right? This is all about saving the banks, ensuring their profitability, ensuring their capital, and making sure that the banking system doesn't fall over. You could also argue, I think, that keeping house prices high is, again, bank keeper, because everybody knows that this is all about financial stability. If the banks were to fail, this would be a major catastrophe. We've got ourselves into a massive U-shaped problem where we've got very low debt, very low rates, massive amounts of issues here. Very hard to see how we can get back out again.
And Martin, so under your longer term crunch scenario, which you've given obviously the heaviest weighting, 40%, you've actually got in there one bank bailout.
Yes.
Colour that one in for me. So is that a bank failure, or is that a
bank?
Yeah.
Well,
what are you calling here?
You could actually argue that all the banks have been bailed out to an extent already.
Exactly. Yeah. Okay. Yep.
My theory is that in that, if that longer term crunch does come through, there'll be one bank in particular who will have significant mortgage exposures, and those mortgages will have to be bought by the Reserve Bank to keep the bank afloat.
Right. Okay. Here we go. We'll wait and see. Now, we've got a few questions, actually. We might just pause for questions before we roll into the final piece of the show with the investment outlook. Just on that, so I've got, here we go. I'd like to hear your thoughts on Aussie shares and bonds on a 3, 5 and 10-year outlook. Have you polished your crystal ball, Damien?
Yeah, that's right. Look, Aussie shares. Okay, so let's start with the bonds, because I think the bonds on a 3-year outlook are going to be where they are now. Maybe a bit lower. Like you're going to go lower first, I think. Maybe you're starting to rise again.
Yields, not prices.
Yields. Yes. Yep. On a 5-year basis, well, odds are you probably haven't really moved as well. But maybe, I guess maybe by then we've had enough pain that we will actually see some reasonable fiscal spend, and you're into new election cycles and stuff like that. So yeah, I think at that stage you're basically saying, has a politician sprung up promising to spend lots and lots of money and to try and redistribute back to poorer people? And if that's the case, then I think you've got a prospect for recovery, sort of at 5 or 10 years. If you haven't, if we're just trying the same stuff we're trying to do now and more of it, then I think bonds are basically staying where they are for 5 or 10 years. But I don't think they're moving until we do something different. I guess is the answer. Shares are different. There's some quite positive short-term things going on. There's some quite negative medium-term things going on, and I think there's some quite positive long-term things going on. So yeah, I think there's a short-term bit of a push on at the moment. I think there's a lot of concern in the medium term. I think if you got considerably lower prices, then there's a number of factors we're looking at in the sort of mid and late 2020s that will actually be quite positive for corporates. And so it's a matter of timing. I certainly just dumping your money into an index fund and going away for 10 years. I'm not sure that's going to be give you a great outcome, but I think there's certainly going to be some great opportunities.
Okay, yeah, sure. Anything on the stock and bond market, Martin, or?
Well, I need to say, one of the big questions is the future going to be inflationary or deflationary? I actually did an interview on my channel with Peter Schiff yesterday, and he, of course, is a very, very strongly inflationary and believes that gold is the only sure thing in town. I spoke to Harry Dent the other week, again on my channel, who's a deflationist and basically saying it's all going to fall over and you should therefore not touch property and you should not touch gold, etc., etc. And what's fascinating is this polar view of deflation or inflation is wherever you look, everybody's got different views. I don't think anybody can tell at this stage. I genuinely don't know that it's feasible to forecast precisely how this is going to play out, because we assume central banks will go on doing more of the same thing. We assume rates will go lower. I assume negative interest rates. I assume that eventually the virus will get under control, or that will take a long time. But I'm not sure that central banks have a way out of the hole they've backed themselves into.
But are you probably, Martin, and I concur with most of that. I guess what I'm thinking is, if nothing changes though, there's not an obvious way where inflation is suddenly going to pick back up and revert to trend, and where we'll all sail off happily into the sunset. We actually need a significant change before we're going to see inflation.
Well, of course, that's all the discussion about the quote "Great Reset," right? And they quote, all the recent discussion. The point there, though, is it's nice to talk about it in theory. The question is practically, is that likely? I think we're just going to muddle on. I wouldn't be surprised to see in 5 years' time we do precisely what Japan did and what the Eurozone is. And by the way, both there, inflation is not an issue; it's deflation that's their big issue. I think that's probably our future.
But with the most of the people who are very worried about inflation that I listen to and read seem to have their logical step seems to go, governments are now starting to spend a lot on fiscal. They won't be able to stop. Therefore, the taps will be completely wide open. Therefore, inflation is coming. And I guess I'm sort of feeling that there's a logical step in there, which isn't like they're basically saying things will change because they have to, and therefore inflation will be here, versus what you're saying, which is what I agree with. Until things don't change, we're stuck following the path of Japan and Europe.
Well, the key question for me is, all this money that's being created, where's it going, right? Is it going into the real economy? Is it going into real prices? No, it's not. It's going into some assets. It's going into financial markets. So it's supporting house prices to an extent. It's supporting stocks to an extent. It's supporting zombie companies significantly, and a lot of that. But it's not going to the real economy. So I don't necessarily think that we're going to actually see significant inflationary consequences unless something changes.
Yep, I agree with that. Another one there, we mentioned gold before. Thoughts on gold, or view on gold in Australian dollar terms, please. Normally we have David Llewellyn-Smith who gives a good view on gold, but anything of note from you guys?
I think there's some short-term headwinds. Is sort of from a reflation trade, and the sort of value rotation we're seeing. The US dollar falling. So, I think that the things to note is US dollar is going to be a big one. If the US dollar is going to be weak, then that's got its issues for gold. I think there's what else is there? Inflation's your big one though. If you're worried about inflation coming back, then you want gold. But gold as well, to me, is a second derivative. Often it's if you think other people are going to be worried about inflation, then then there's a gold trade in there as well.
Very good. Anything from you, Martin, on the yellow stuff?
Well, I've always said I understand why people are attracted to gold, and people read or try to read what happened in the 60s and 70s, where we had very strong inflation, and of course, previously when we had the gold standard there. We are in a bit of a different new world, and I'm just not quite so convinced as some. Peter Schiff is saying it's at least 5,000 US, probably even more. I'm just not quite so convinced, but there are compelling arguments for and compelling arguments against. However, I have to say that, of course, if you're actually in the gold selling business, then of course you're going to be talking gold, just as if you're in the Bitcoin environment, you're going to be talking Bitcoin, et cetera, right? It's hard to get a really good, objective, independent view because everybody, of course, has a consequence and a frame of reference within which they're working.
Yep, fair enough. No, that's right. I've had a bit of a pick through. I think we've got most of the questions out of the way, and those that have asked, I think we've covered off on it as well. So rather than going back over again, but we will jump into. Sorry,
there's a vaccine one actually there. That's just was it just asking the thoughts on the Pfizer vaccine? That's from a Cookie Boy.
Yep.
I think there's I think that the things to note with the Pfizer vaccine is it does need to be stored at 80 degrees, negative 80 degrees, and and you need 2 shots.
Yep.
So I think within developed countries that's not going to be a huge thing. It means you won't be able to get it from your doctor's surgery, But but I think if Australia wants to do it, they'll just set up these drive-through things that they're similar. They've already got the testing centres. You'll just drive through and you'll get your shots and off you go. Having to get 2 shots means it'll be a little bit problematic. But I guess what I'm talking about from that is it means your less developed countries are going to have trouble. And so there's certainly, will it still be circulating in the world, and you're still going to need travel bans and stuff like that? You're probably going to need, or restricted travel, you probably will. So it's not completely back to normal.
Would it be easier just to have it at just park all your shot stations at the airports? So if you're coming in, you get a shot. If you're going out, you get a shot. Everyone gets a shot, but everyone on the island's okay.
Yeah, maybe, but I guess there's a. I don't think it's not an immediate panacea. I guess I think and it's still early stages. Like there's lots and lots of vaccines that have been developed and made it through to even into starting to be pushed out to people, and then suddenly they've realised that
found a problem.
It causes a problem in 1% of people. It causes brain damage or whatever, and so then they go, okay, well we're going to pull that back. Or there's other cases where the virus itself just mutates, and that's Martin mentioned that as the human to mink and then back to human in Denmark. One of the major issues about having the virus running so rampant throughout the world is what we're doing is providing it a petri dish to try and mutate. Is he basically saying, if it was limited to small amounts of people and there's only 10,000 people with it at any one point in time, then the ability for it to mutate is just with random mutations is so much lower.
Yep.
Whereas when you've got 10 million people with it, then the chance of mutation is just is significant. And so so the vaccine's certainly positive, and but I think one of the big short sellers, Bill Ackman, was out yesterday saying he's gone back short on it, and what he's worried about is that, especially in the US, is the economic outcome. But the people will go, vaccine's coming, I don't need to worry as much about it. And it's like, well, it's coming, but it's still not coming for a while yet.
Yep.
And so getting out into the getting out and not worrying about a mask at the moment because there's a vaccine coming is not a smart thing to do.
Yep, sure. One other question I've got here, this one's actually emailed in. I promised that I'd read it out, so I hope the gentleman's listening today. You seem to only hold one of Berkshire's top 10 holdings. Obviously, they are a company with a hell of a record. Any idea on why that is and the current reasoning for the holdings in our international portfolios? This is Nucleus Wealth. Maybe if we just kick off on the Berkshires, I'm not sure. Yeah.
I
might have play.
Can I? Yeah, I might need to have a look at the what their holding list is, and without seeing that, it's tough for me to comment.
Yep, no,
I mean, we
fine.
certainly have a similar outlook in terms of value and quality.
Yep.
We're probably a little bit more quantitative about it in terms of the way we approach, but there's a universe of 1,600 stocks. I'm pretty sure a lot of the stocks that he's got in there will have very similar characteristics to what we have. It's just a matter of going, well, if we're both running portfolios of, there's 200 or 300 stocks that we can both buy, and we're both running 50, 60 stock portfolios, then there'll be overlap. And then I think there'll be a lot of the same features that you'll find in the companies, but I'd have to have a look at his list and see if there's any where we've got a significantly different view.
Yeah.
I think we're probably a little bit more tech heavy, as we've been certainly a bit more tech heavy than he has. Having said that, he has been changing it a lot.
Yeah.
Because I think one of the key things to note is that, especially from this last reporting season, there's been a lot of companies reporting just fantastic profit results, and they tend to be living in that whole tech sector. And there's a lot of them where it's very hard to see what the what's going to stop the profit results from coming.
It's sort of one thing I've noticed with the Buffett sort of Buffettology, or Warren himself, is he's very good at being very patient until there is a big disastrous tip, and he can start walking in and effectively being that sort of lender of last resort, or equity purchaser. But it feels like the central banks this time around have rubbed him out of his own trade. They've crowded him out.
A little bit, but and the other thing to note though as well is that he's obviously he moves a lot slower than we do. Not that we trade a lot, but more in terms of when he buys a stake, he's buying a huge chunk of the company, and he finds it very hard then to, like, he can't just turn around and say, I've decided that I like Kimberly-Clark better than Honeywell, and so I'm going to switch between one and the other. There's both sort of industrial value stocks in the US, whereas we can make that change. Whereas for him, it's to have a meaningful stake. He's got to go out and buy 10% of the company.
Yeah,
and it's not something you'd sort of go,
well, overnight.
Yeah, that's right. He might have a view. Yes, I could pick up 10% by doing that trade, but I'm going to lose all that in doing the trade in the first place.
Yep.
Whereas for us, we can say, if we can pick up 10, 15%, and we might lose 1% in doing the trade, or less than 1% in doing the trade, then yes, it's worth doing.
Okay, sure thing. Very good. All right, we'll zoom through. We'll jump into now the investment outlook as well. You've got some kick off with the key positive factors, if you like, Damien.
Yeah, I've got a piece coming out very shortly with all this in there, but I just thought I'd run through really quickly that this clash of because I could spend another hour and a half going through this, but it's sort of like the bit of the clash of the titans with these positive factors and negative factors, where you've got the US, you've got there's people talking about saying, well, the Republicans are going to let through some stimulus at least, but they're going to block any tax rises, and so it's like basically go, is that the best of both worlds? The earnings season has been really good. Inequality, they're not going to be raised. Again, tax cuts aren't going to be coming through. So when I talk about positive factors, these are positive factors for shares. So if inequality stays high, that we've still got this bit where some people are actually doing better. The rich are doing better, and they're not spending their money, so they're just dumping into the share market. You've got all these things about limited bankruptcies and evictions, and wage growth is really low. So if wage growth is really low, then that means company profitability is quite good. Oil prices are low. You've got more policy certainty. You've got this structural change in industries, which often then there's profitable stages where a lot of companies got to sack a bunch of people, sack a lot of their middle management, and often find that then there's a lot of efficiencies they can gain, and they don't end up hiring them back. And so there's all these positive factors, and then I've got all these negative ones on the other side, which is the virus is going ballistic, especially in the northern hemisphere at the moment. Valuations are just ridiculously high. We've got all these latent bankruptcies we spoke about before, and I spoke about that low genuine. So not only is credit growth low, but genuine credit growth is even lower, because a lot of the credit growth is just people financing existing debt and paying interest or not paying interest. Mm-hmm. And so we've got all these negative facts. The issue is most of the positive ones are all very short-term issues, and most of the negative ones are all medium-term issues. Mm-hmm. And so, so when you balance it out, is actually, well, is there a we sort of upped our equity weights before the election on the back of sort of markets had come back a bit, and there's just a little bit of clear air. We're certainly nowhere near fully invested. We're still very conservative, but there is this clear air bit at the moment, which could turn, but there's certainly a lot of sort of very short-term positives out at the moment, which is why we saw markets sort of rally over the last couple of days in particular. Mm-hmm. So, I guess it's trying to weigh up this whole clash, and it does seem as if, so similar to what we're seeing in the housing market. What we're talking with Martin in the housing market is, in the short term, you can see where positive factors will overwhelm the negative factors, but in the medium term, these aren't issues that can just be ignored and assume that they'll go away eventually. Is that these bankruptcies eventually have to be resolved. Whether it means that it's resolved in just low demand for decades, or the sharp, we'll take the pain now. There is a resolution to them. It's not we can just ignore it until it goes away.
Plenty to think about, I'm sure. So lots of factors. So anyway, we might have to leave it there just in the interest of time. But we do have a couple of announcements coming up actually. So I'll jump across to some design work that's been done, Martin.
Yeah, so
good.
So basically, you may know that Walk the World is my YouTube channel, and people always ask me, why was Walk the World different from Digital Finance Analytics? Well, the secret, of course, is that Walk the World is a bigger universe than DFA. DFA is my analytics company, basically. But because of something which we're about to mention now, what we've done is just scored the walktheworld.com.au web as my sort of central point. Mm-hmm. And that allows us then to take the conversation forward. So you can go to Walk the World and see all the YouTube stuff. In fact, you're coming on my channel next Tuesday to talk about some of the investing environment stuff because it's such a critical time, which is great. But the point there is we've also now got another important announcement in terms of using the Walk the World brand to actually connect more strongly with Nucleus Wealth.
Absolutely, yeah. So I guess there's a formal announcement, and for those listening in live, you're hearing it for the first time. We're bringing out, I guess, a partnership. Essentially, is probably the best way to put forward between Martin and the Walk the World channel and listeners, and obviously then offering that through our investment service here at Nucleus Wealth. It's called Walk the World Fund and Walk the World Super. Damien, I'm not sure if you've got anything to add there on your part?
No, look, we're very excited about the tie-up, and we certainly value Martin's research, and I think I guess what it is we both think we have a similar this similar view about we're trying to do what we think is best for investors and trying to sort of cut through and change the system. So Martin's sort of, I guess, more on the media front is saying, well, he does want to talk in detail about some of these issues and dig into what might not be covered elsewhere, or might be there's a lot of our big media companies also have other divisions that are involved in property, and so it's often very hard for them, even if they do think property isn't good, to go around and
speak against your vested interests.
And I think we're sort of trying to do so Martin's have got a very independent voice in that space, and we think we've got the similar thing in terms of the investment side, and that's really what we're trying to do is come back and say, well, we're not being driven by the fact that we feel we need to try and bid up prices because we make money from brokerage or whatever it is. We're just trying to have a financial product that gives the best result for investors, and at a price that everyone can afford it, and be able to give advice that goes with that, and so I guess what we're hoping is that between the two of us, we can improve on this product, and the bigger we get, the more we can drive down some of our admin costs as well. Which is we treat that as a big goal of mine is to keep bringing down costs. We've cut our fees sort of 3 times since we launched, and the bigger we get, the more we can keep driving down those costs.
Absolutely, yeah.
And the point I'd like to just add here is one of the things that I think why this is so important is I have a lot of followers, and a lot of people ask me more specific things about investments. And of course, I can't do that. I'm not allowed, do not give investment advice. So I've been searching for a mechanism whereby people can get a little bit more guidance and, frankly, follow through. And the beauty of this relationship now that we've created allows people to navigate through for themselves. So you can go via walktheworld.com.au, go through, and you can get to the Nucleus Wealth. It's all powered by Nucleus Wealth, but they've got this wonderful flavor of advice. So you can pretty much be self-autonomous digital platform, or you can get some guided advice, or they can even recommend specific advice. So it allows people to take the conversation beyond tell me about what's going on in the market to making more strategic investment decisions. And I just think this is a really critical time. Many people say to me investments are a thing I don't really want to think about too much, but they had deposits, and now deposit rates are completely stupid. So they have to, and Phil Lowe said, you have to be exposed to the market. So this is a mechanism whereby we think that there is a sensible way of thinking about investing in the current environment, not taking massive risks, not trading. This is investing, very important to make the distinction. And so we think there's a win-win here, and hopefully our audiences will agree. And as I say, you can follow through, go to the walktheworld.com.au, go from there, and you can go through into the Nucleus Wealth world. And we've worked quite hard to make it really easy. Lots of videos to show people how it all works, and you can experiment without actually committing. You can see how it all works, and I just think this is a really creative solution to probably one of the biggest problems we face at the moment.
Absolutely. Yeah, and just on that, of course, you can head over to walktheworld.com.au and have a look at some of Martin's content if you're not familiar with his channel, and obviously his work with digital finance analytics as well. So on that note, I think we'll have to finish up there. But look, thanks very much for your time, and thanks very much for sharing your thoughts as you do with those wonderful data packs and your scenarios and all the other work that you do. And once again, Martin, pleasure to have you on the show as always.
Well, thanks very much. I enjoyed speaking with the audience and with you guys. And of course, you'll be on my show on Tuesday evening at 8 p.m. Sydney to return the favour.
Absolutely. Yeah, looking forward to it. And thanks to you, Damien, as well, for another great show.
Thanks, Tim.
Lovely. All right, so our viewer question of the week, we popped up. We just thought, as a matter of interest, just to see if you were looking at buying an investment property in 2021, and if so, where? We'd be interested to see where those areas may become enticing for property investment going forward. Although, given the content of today, it'd be interesting to see maybe why not as well. But anyway. So coming up next week, we have Dr. Stephen Hales. So Stephen holds a PhD in economics and is a lecturer at in the topic at the University of Adelaide, where he uses modern monetary frame to understand macroeconomic issues. Following the same monetary expansion theme as today, we're chatting with Stephen to get his thoughts on the extent of where central banks supporting weak economies ends and modern monetary theory begins. And it's starting to feel like we might be there right now. So tune in next week, Thursday, the 19th of November at 12:30 p.m. for a live chat with Dr. Hale. And of course, head over to our YouTube channel, Nucleus Investment Insights, to ask questions along the way. Thanks to all those who have watched in live for another great episode, of course, and for all those who've asked questions and for all the comments. I have a hard time keeping a track of them whenever Martin's on our show, so that's wonderful. And I hope you've taken away some great ideas. If you'd like to see more of our content, head over to nucleuswealth.com/content to stay up to date on news from us. Follow us on social media. And finally, if you know someone who would get something out of today's episode, let them know about it, share with a friend, and help our show grow. So thanks again for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you with the next one.